Today's video is going to focus on one of the biggest topics shaking the tech and investing world right now. Serious concerns about Nvidia's revenue numbers and whether the company may be recognizing revenue in a way that raises red flags. This story exploded after famed investor Michael Burry, yes, the same Michael Burry, who predicted the 2008 housing crash, publicly warned that something does not look right inside Nvidia's financials. So let's break this down in a way every viewer can understand. First, what Burry is claiming. Michael Burry recently shorted Nvidia, meaning he is betting the stock will fall. But it's why he shorted it that has everyone talking. According to Burry, Nvidia is investing billions of dollars into AI startups. And those same startups are then using that money to buy Nvidia chips. This creates a suspicious cycle. Nvidia gives them money, they use that money to buy Nvidia products, Nvidia records that as revenue. If this is true, it means Nvidia might be creating its own demand, which artificially boosts sales numbers. That does not automatically mean fraud, but it does raise questions about how genuine the revenue growth really is. Second, the revenue recognition issue. Here's where things get more serious. When analysts looked deeper into Nvidia's numbers, they found a major gap between net income versus free cash flow for the last 12 months. Net income, around $100 billion. Free cash flow, around $77 billion. A $22+ billion gap. Normally, a gap like this is explained by huge capital expenditures, money spent to expand factories, buy equipment, etc. But Nvidia's capital expenditures were only about $5.8 billion. So the big question becomes, where's the missing cash? Why is the profit so much higher than the money actually coming in? This exact pattern, big profit, low cash flow, is what exposed several major accounting scandals in the past. Again, not saying Nvidia is committing fraud, but the pattern is concerning, and it does not match the story Nvidia is telling investors. Third, analysts noticed this before Burry did. In fact, many financial analysts started pointing out this issue months ago. Some said Nvidia might be recognizing revenue faster than they are receiving cash. Meaning, they book sales immediately on paper. But the actual money hasn't arrived yet. This inflates earnings, making the company look more profitable today than it actually is in real cash terms. That's exactly what happened in past corporate blow-ups like Enron, where they counted future profits as if they had already happened. To be clear, Nvidia is not Enron. But anytime this kind of gap appears, investors have to pay attention. Fourth, Nvidia says everything is fine. Nvidia's CEO Jensen Huang recently said, "We are not in an AI bubble." But remember, no CEO is ever going to step in front of a camera and say, "Yes, our stock is overpriced and our revenue recognition looks questionable." They have a vested interest in keeping the hype alive. That's why investors should look at numbers, not opinions. Fifth, what you should take away as an investor. Even if Nvidia is a great company, and it absolutely is, that does not mean the stock price reflects true long-term value. You must ask, is Nvidia's revenue real demand? Or demand Nvidia created by investing in its own customers? Is the company truly generating record profits? Or just recording profits before the cash exists? Is the AI boom driving sustainable growth? Or hype-driven temporary numbers? Because when price grows faster than real value, the stock eventually corrects, and the correction can be brutal. Final message to viewers. Nvidia is an amazing company. They dominate the AI chip market. They have incredible margins and unbelievable growth. But even great companies can get ahead of themselves. And when someone like Michael Burry, known for spotting financial issues before anyone else, publicly warns about suspicious revenue recognition, it's something every investor should at least understand and pay attention to.